let's take a closer look at the roles within cash equities, including what is the difference between sales trading and sales research. Let's talk about what is cash equities. It's a fancy word for stock trading. Equity groups are generally split between cash and derivatives. It's also worth noting that cash equities is set up differently than other groups in sales and trading. One of the key differences is in cash equities, most of the trading is done on the exchange versus an over-counter trade with traders in every other market. With electronic trading and automation, there's less of a need for an actual trader in cash equities. For example, in the year 2000, Goldman Sachs had 600 cash equity traders in New York. Today, they have 2. One to do block trades off the exchange, and one to back up that trader when they go on their mandatory 2-week vacation. Cash equity trading is done on an agency basis. The investor calls up the sales trader at the investment bank and tells them, I want to buy 100 shares of Apple at market. The sales trader routes that order to the exchange, telling the exchange, I want to buy 100 shares of Apple at market. The exchange fills the order for the investor. The investment bank makes money on the commissions for that trade. There are 2 main sales teams within cash equities, sales research and sales traders. They cover different contacts at an investor, in this case, an asset manager. Sales research covers the portfolio manager. They make the investment decisions in terms of what names to invest, which names they want to overweight, and which names they want to underweight. We'll talk more about overweighting and underweighting in our lesson about asset managers. Sales traders cover the traders at the asset manager, also called the execution team. The sales traders work through the best strategy to execute buy and sell orders, whether new stock buys from fund inflows, stock sells from fund redemptions, or new buys from shifting views by buying one stock and selling another. Sales research is a gatekeeper to equity research, also called analysts. Note that analysts in equity research are senior research staff. You might overhear a call from an investor wanting to speak to your analyst on Apple. This is a request to speak to equity research, not the new hire on the sales desk. Once the request comes in, sales research arranges the call with equity research, in this case, the technology analyst covering Apple. In addition, sales research can arrange one-on-one meetings with company management. This is typically done at a conference that the bank is hosting. If the bank is hosting a technology conference and Apple management is attending, they can arrange a one-on-one meeting with key investors. The corporate access team works with the bankers that hold the relationships with the companies to arrange these meetings. Sales traders focus on execution. Following the call that the portfolio manager had with the Apple research analyst, and the meeting with Apple management that corporate access facilitated, the investor decided to buy Apple. The portfolio manager communicates the desire to add Apple stock to their fund, and the trader at the asset manager works with the sales trader to develop a strategy to buy the stock. Once the strategy is developed, the investor will communicate the order. The sales trader places the order on the exchange and collects a commission. In the entire process, the only revenue source is the commission. Part of the commission is allocated to research, and part of it's allocated to trading or execution. Overall, both sales research and sales traders work with their clients to ask for their fair share of commissions to compensate them for the services that they are providing. So once a trade is done, what happens? First, the trade needs to be confirmed. The trading systems generally generate the confirms for you. For high-touch trades, you as the sales trader may need to approve the confirm by checking the details and ensuring the trade details and commissions are entered in correctly. For low-touch trades, these are generally sent automatically. The bank sends the confirms to the investor's trading team, which is their front office, as well as the investor's middle office. The next step is affirmation. This is ideally done the same day. The investor's middle office affirms the trade. What this means is that they've reviewed the confirm and agree with the details of the trade. This is an important control step to ensure that both sides agree with the details and it's booked in their systems the same way so settlement amounts can be processed. The final step is allocating the trade. For asset managers that manage many funds, these funds are the end investors that are going to receive the shares. The allocation process splits a larger trade into various funds. Once the asset manager provides these splits, the bank's middle office team enters them to ensure that the settlement instructions are matched. We just finished discussing the roles in cash equities, including sales trading and sales research. In the next video, we're going to discuss the exchange and how the exchange matches buyers and sellers. After that, we'll discuss what we need to place a cash equities order. We'll see you in the next video.